I'm going to cover the basics of GST. This is covered in full detail in Chapter 8, pages 153 to 174. By this stage you should know though that GST is a goods and services tax. It was introduced in the year 2000. It's an end user tax is how they explain it. So we keep a track of the coming and going of GST, but ultimately the consumer is the one who's meant to pay it. Okay, so how do I work out the GST? As the GST amount in Australia is currently 10%, you simply add 10% to the GST exclusive price of the goods. So whatever the retailer is going to sell the goods for, they just add 10%. So for instance, if a jumper is worth $70 excluding GST, they multiply the $70 by 1.1 to get the GST inclusive amount. If you multiply something by 1, so 70 by 1 is obviously 70, 0.1 is the 10%. So that's a very simple calculation to get the GST inclusive number. If you're not confident with that, you take the GST exclusive amount, divide it by 10, so that equals 7, and you just add it to the original amount. Either way, you'll get the same result. If you know the GST inclusive price, and you would like to know the GST exclusive price, and this you'll need to do quite often. An example will give you the total amount including GST, but when you're processing it into your journals and into your financial statements, you need to separate the GST out. So this is when you'll need that. You simply divide the GST inclusive price by 11. Okay, so 77 divided by 11 equals your GST amount, and then you just deduct it to get your 70. The reason why you divide it by 11, I'll show you here. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So those 10 sevens equal the $70. Then we add the GST. Now we have 11 sevens. So that's why we divide it by 11. We just get it back to the GST amount. So where does this information go in the financial statements? GST paid to suppliers. So the GST inclusive amount of the purchase is the expense, exclusive amount, I beg your pardon, is the expense or the asset, and is dealt with accordingly. So it's an expense if, for instance, it's a one-off purchase and it's a disposable item. If we're purchasing an asset though, they also attract GST and they get processed in the balance sheet. So if a business purchased stationery, it's a consumable, it's an expense. For $110 including GST, then $100 of that goes into the profit and loss statement as an expense to stationery. The $10 of GST is processed to the balance sheet as a negative liability called GST clearing account. So the GST clearing account is where we put GST that we have collected, and we also record GST that we have paid. Remember, it's an end user tax, so we're purchasing these goods to sell, so therefore that's not the GST that we record for the tax office, that we send to the tax office. So it's a negative liability because it's reducing the amount of GST that we actually owe. On the other hand, GST received from customers, it's not actually our money. So the GST exclusive amount of the sale is the revenue and is dealt with accordingly, whereas the GST, remember, we're just collecting that on behalf of the Australian Taxation Office. So if a business sold an item for $110 including GST, then $100 goes into their profit and loss statement as revenue. The $10 of GST is processed to the balance sheet as an increase in the liability called GST clearing account. So it's just the one account, GST clearing. The liability side is the increase in the liability is when we collect GST from our customers. Reducing the liability, or the negative liability, is when we have paid it. So how do I know if it's a liability or an asset? As businesses conduct their business to make a profit, it is assumed that you would have collected more GST from the sale of goods and or services then you would have paid. We're in business to make money, so if you're not making money, you're not very good, don't have a very good business. Instances, though, which will result in the GST control account having a debit balance. So remember, that's the negative liability. So we are collecting more back from the ATO than what we've paid, and therefore being recorded as an asset. So you might have put in a bulk order of stock. Just say you've got a retail business like a dress shop, and you would do all your purchasing in 2 lots. You'd buy all your winter stock, say, I don't know when they buy winter stock, maybe February. And so they might have actually purchased more than they've sold in February. And then one other month of the year they will be purchasing their summer stock, say in August. And so they may actually purchase more than they sell. The rest of the year, though, obviously they're selling their stock and they're not having to replenish it, and they would be earning more. Or in the instance of where they purchase a non-current asset, a non-current asset which would attract GST would be a car, for instance, and so that might be a month where they have paid more GST than what they have collected. So they are due a tax refund. Here we go. This is what our GST control account looks like. Debit transactions are those which decrease the GST liability. Credit transactions are those which increase the GST liability. So as you'll see on our debit side, the GST column of our cash purchases journal, the GST column of our credit payments journal, and the GST on any purchases recorded in the general journal. Purchases recorded in the general journal would be things like non-current asset. On our credit side, that which increases our liability is the GST column of the cash receipts journal, the GST column of the credit sales journal, and GST on any sales recorded in the general journal. So if we sold one of our non-current assets, because we're a business, we still actually have to charge GST on that, and that might be processed through the general journal. If you have any problems with this, please discuss it with me. But this GST control account really is the summary. This is what you need to know. You need to be able to reconstruct the GST control account, so you need to know exactly what goes in the debit and credit.